what we're going to be going over here, warrants issued with bonds where the option to acquire common stock is separable versus non-separable from the bonds here. So for example here, Corporation A issues $18 million worth of 12% bonds along with warrants to buy 1.2 million shares here of common stock at $18 per share. So the warrant here, you can buy a share of common stock at $18. Now the bonds mature over 10 years here, and they have 1.8 million per year here at maturity. The market value of the common stock here when these bonds were issued with the warrants is $23 per share, and the company received $20 million when they sold these bonds with the warrants. Now point 4 here, a 12% bond interest rate is considered relatively low borrowing rate for Corporation A, and they should be actually paying a higher interest rate than this 12%. Okay, so let's look at case 1 here. This is where we're assuming that the bond debt here and the warrant equity are inseparable. Now, the option to acquire common stock is inseparable in this case from the bonds. This would be the case for convertible bonds. Now, this is where and we're going to be looking at allocating the proceeds that we received here on the sale of these bonds with the warrants. So the entire proceeds of the bond issue here should be allocated to the debt and any related premium or discount on the bond here. There should be no allocation to the warrants since these warrants are and the bonds are inseparable. So how would we record this here for our how we would allocate our proceeds here? So for our cash account here, this is with the bond plus the warrant. We would debit that here for $20 million, for that's the cash received on the sale here. And then moving over to our bond payable, we'll set up a bond payable here. That's really the issue value. It would be like the par value here. So we'd credit that here for the issue amount here of $18 million. And then if we go over here to our warrants, what we would allocate is paid-in capital here for the stock warrants. It would go as a zero amount here. The warrant, any shareholder equity, we would include here as a zero amount because the warrants and the bonds are inseparable. So everything goes into our bond liability here based on the cash receipts. So based on our cash receipts here at $20 million here and the bond par value here, credit that for $18 million. So we just simply come up with the premium here, which is really a balancing amount here between our cash receipts and our bond par. So difference gives us $2 million here. Credit premium account here, that would be allocated to the premium account here in bonds payable, $2 million. Credit here, bonds payable for $18 million. That balances with our cash amount here of $20 million. Okay, so we've taken care of case 1. Now let's move up here and looking at case 2. This is where we're assuming the bond, the debt here, and the warrant, the equity, are separable. That is, they can be separated here. Not that they are, but we're going to assume that they are separable. So this is where the bonds and the warrants are separable. The proceeds of their sale should be allocated between them, between the bond and the warrant in this case, based on the allocation of their relative fair values, and it's usually determined by the market price here, which they can be traded on some open market. But now here's the case here where we really don't have any open market on these bonds or these warrants here, but the one thing we do know is the common stock at that time is selling at $23 per share. Now if we're exchanging warrants for common stock and our warrant is priced at $18 per share here, and we know the market value here of our common stock at 23, so really the difference here is it can be allocated to the warrant, and we'll look at that. And the bond, the 12% interest rate here is assumed to be low, so we can assume that we're going to have a greater discount on these bonds had we actually been charging the actual interest rate that should have been. Even though they were issued here at 12%, we're going to assume that they should have been issued at a higher percentage. So really we've got a decision to make here, but since we do know the common stock's market value here, and we also know that the bond discount or the bond interest rate here is relatively low, we can make some judgments here on how we can allocate the receipts between the bond and the warrant. And total sale receipt here is $20 million as we had before here. Now we can allocate to the warrant here based on the market value of the common stock versus the difference here in the warrant price. Market value is $23 here per share common stock, less the warrant amount here that they can purchase that common stock at $18 here. So that difference times the 1.2 million shares of common stock for those warrants here is going to give us are allocated to the warrant here of $6 million. So we've got the total receipts here at $20 million, $6 million go to the warrants, so the remainder would be allocated to the bond, in this case of $14 million here. Now the bond is allocated at a discount, so the bonds payable, the face amount here was $18 million, so the difference between $14 million allocated here and the $18 million that a face value or the par value of this bonds goes to a discount here of $4 million. And it makes sense here because the discount here is rather large on these bonds, but it's because as well here they could have actually been paid, had to discount them a greater amount here than the 12% because the bond here, their interest rate for purchasing or interest rate that they have to pay to borrow money would be greater than the 12%, so you can expect a greater bond discount. So our judgment here, where we would allocate based on that price of the common stock here for that's outstanding for the warrants here, and the fact that we have a large discount on these bonds, it makes sense here in our allocation. So how would we record this? Again, just going down here, same thing, our cash account, cash received goes to the debit that here for $20 million. Now we know what our bond, we set up our bonds payable here based on that issue value or the par value, credit that here for $18 million. But now this is the case here where we're going to credit $6 million going to this the warrant or equity account, shareholders equity in this case, because the bond and the warrant are separable. In this case, we're allocating, as we did up above here, credit our paid-in capital for stock warrants here for $6 million. That's shareholders equity again here. So really the balancing amount goes into a bond. In this case, it's going to be a bond discount that's allocated. Everything's sitting here on the balance sheet. So looking for our bond discount here, we're going to debit that here for $4 million, and that's the allocated amount that we calculated above, and it's simply looking at our debits, cash received here at $20 million plus our debit here, discount of $4 million, that adds up to $24 million here. And again, it's a balancing amount, this bond discount here, versus our credits here, bond payable $18 million, and the paid-in capital here to stock for our stock warrants here, the paid-in capital equity account here of $6 million, $24 million. So just a balancing between debits and credits here. But what we want to point out here, when we issued these bonds here where they were and the warrants were inseparable, we actually had a premium account here between the cash amounts we received, the par value of the bonds. We come up with a premium account here. But you can see how it changes here when the warrants and the bonds are considered separable here. In this case, we had the balancing amount came up to a bond discount, and then for when they were separable here, the warrant we allocated to our shareholders equity the amount that was based on that market value of the common stock that we sold here. So that's how we'd have to make some judgment calls in some cases here, but when they are separable here between the bonds and the warrants, then you're going to have some allocation here to shareholders equity for the warrants. However you divide that up here, in this case we were able to peg it to the market price here for a share of common stock. We knew what our bonds payable amount here was based on its face value here. We knew our cash proceeds here, so the balance went to, in this case, a bond discount. So in this case here, you can see you're allocating some equity and dividing up your amounts here, that your proceeds that you received here between your bond debt liability here and some equity account here as a warrant or stock warrant paid-in capital equity account. Whereas when they were inseparable, the bond was inseparable from the warrant, everything went into the liability account and there was nothing going into the equity based on the cash receipts we had here. Okay, so that covers our topic here, and we looked at these warrants that were issued with bonds, and we looked at both cases here where they would be inseparable here, or the bond and the warrant, and also the case here where the warrant and the bond could be separated in some fashion or another. Okay, so that's the end of our subject here.